Okay, we've all heard the old adage, right? To make high returns, you have to take massive swings. Well, in this explainer, we are going to completely dismantle that pervasive myth. We're going to break down exactly why maximizing your risk is absolutely not the only way, or honestly, even the best way to maximize your wealth.
I mean, want to become wealthy faster? That's the ultimate question, isn't it? It's literally the exact thought driving all that intense financial FOMO among retail investors today. We all kind of want that shortcut, that fast track, the secret cheat code to financial freedom. And because of that intense desire for speed, we're just constantly bombarded with these high risk temptations. Think crypto, startups, day trading, highly leveraged real estate, wild individual stocks, borrowing on margin. These are the flashy assets you constantly hear about online, the ones promising overnight riches that make us feel like we're somehow falling behind if we aren't betting the farm on the next big thing.
Section 1. The high risk myth. See, we usually just assume that risk and reward move up together in this perfect straight line. But higher returns, they are definitely not a guaranteed outcome of taking higher risk. Look, every single investment involves uncertainty. And yes, the potential for a bigger return usually comes with the possibility of bigger losses. But taking on massive risk doesn't magically guarantee a massive reward. Sometimes it just gives you a geometrically greater chance of losing absolutely everything you put in. Section 2. Affording your risk.
Let's think about this. Imagine an investor using capital they actually need for immediate short-term liabilities, like rent money needed next month. Their risk capacity is basically zero. Even a tiny temporary market drop could create a massive, immediate crisis. The panic there is entirely real. Now, flip that. Think about an investor putting away money they absolutely know they won't need for decades. Suddenly, they have a massive tolerance for short-term volatility. The market dips, they can just shrug it off because they have the safety of a really long-term horizon.
So the really crucial point here is that your time horizon matters. The timeline for when you actually need your cash fundamentally dictates your capacity for volatility. You just can't untangle the two. If your timeline is super short, your risk profile absolutely has to be low. And this is where diversification comes in. It's a foundational concept, but let's be super clear on what it actually does. It involves owning a broad range of investments to reduce damage from a single badly performing asset or industry. Now, it does not eliminate overall market risk. If the whole global economy shifts, a diversified portfolio is still going to feel the impact. But it effectively reduces concentration risk. It protects you from those catastrophic single asset failures that could wipe out your whole net worth in an afternoon. Section 3. The danger of leverage. This brings us to a specific and frankly highly dangerous mechanic: leverage. Leverage is borrowing money to increase an investment. We all know it magnifies potential gains, but the terrifying part, the part that gets buried in the fine print of trading apps, is that it also magnifies losses. Unlike normal cash investing, where the absolute worst you can do is hit zero, with leverage, your losses can potentially exceed your initial contribution. You could literally end up owing huge sums of money you don't even have. But people just ignore that danger, right? And here's exactly why. 300%. That's the staggering number you hear at a dinner party. You hear about someone on a message board, or a friend of a friend who made 300% on a highly leveraged speculative asset. And the immediate visceral reaction is, oh my man, I'm falling behind. I need to take bigger risks. I'm doing this all wrong. But here is the seriously jarring reality check. 90%. This is the massive, devastating loss that literally nobody ever talks about. You almost never hear about the people who lost 90% of their net worth overnight, and that's just classic survivorship bias. The losers, they're quiet. They delete their trading apps in shame, and they definitely aren't posting about it online. The winners are just incredibly loud, which heavily skews our perception of how common these massive wins actually are. There's a great point from Investopedia on this. They note that recent research and financial reporting continue to highlight how investors can take radically different levels of portfolio risk, particularly when managing investments themselves. When everyday investors get swept up in the hype, especially when they're just self-managing on a smartphone with no advisor around, they take on these wildly different levels of risk without fully grasping the math behind it. They basically walk straight from the strategy room onto the casino floor. Section 4. The True Wealth Equation. Let's step back from the casino for a second. First, let me assure you the goal isn't to eliminate risk entirely. That's literally impossible. If you just stuff cash under a mattress, you're still taking on inflation risk.
Taking some risk is absolutely necessary to grow your wealth over time, but it has to be carefully calculated, deeply understood, and strategically managed, not just blindly embraced because it sounds exciting.
So here is the actual blueprint for the components of appropriate risk. Step 1, it absolutely has to match your time horizon. Step 2, it matches your current financial situation. Step 3, and honestly, this might be the most vital one, it is a level of risk you can actually survive. If the absolute worst case scenario happens, you aren't out on the street. And step 4, it gives you a reasonable opportunity to actually reach your financial goals. If you take one major paradigm shift away from this explainer, please let it be this. The fastest route to wealth isn't necessarily taking the biggest bet. Speculative gambling might give a lucky few a quick spike, but for the vast majority, it just rapidly destroys capital. Smart investing is a completely different game.
The real secret? It's staying financially alive long enough for your assets to compound. Compound interest requires time, uninterrupted time. And to get that time, you have to survive the market downturns without getting wiped out by reckless bets. So as we wrap up, I want to leave you with this crucial question to ask yourself today. Is your current investment strategy designed to help you desperately try and hit the jackpot tomorrow? Or is it designed to guarantee you stay safely in the game for the next 30 years?